let's talk, because you know people love to always take on controversial people.
Go for it, Pete. I'm ready. I'm stealing myself. I'm ready to go.
I'm sure some people out there say, I hope to talk to him about Telstra, because there was a company you didn't like. You didn't like Qantas either.
And do you remember I came on the program, was trading about $2.60 or $2.70.
Got down as low as $2.43.
Yeah, and I said that the value, I thought the value was about $3. So this is the cheapest it had ever been. It had never been below its intrinsic value that much. And it was the first time in about a decade it got below its intrinsic value. But I still didn't buy it. We didn't buy it in our funds. Despite that, we've still done extraordinarily well, but we didn't own Telstra. And it's now $4, whatever it is.
Okay, so to explain to somebody, rather than them saying, oh, Montgomery got it wrong, to explain to them how you would justify why you didn't go for it, and you still got it in price.
Yeah, okay, so the first thing to understand is that we turn up to a game and we play one game. So we've got our basketball in our hand, and we've got our basketball shoes on, and we've got our basketball gear on. We're playing basketball. Now, next door to us, they're playing a game of badminton, and on the other side, they're playing a game of soccer. And occasionally you hear a big cheer, and somebody scores a goal in that game, or they win a point in that game, but we're not playing that game. So Telstra's happening over there, and people are saying, this is great, it's going up. Well, we're playing this game, and we're scoring goals in this game, and that didn't involve owning Telstra. So Telstra has gone up because the yield is being sustained. The company has come out and it said, you know, they've done, this is all old news, but they came out and they said, we're going to sustain our dividend. That means the yield's attractive. I look at my term deposit. My term deposit's given me 4%. There was a time when if you'd saved up $1 million in your life, you were considered rich. And now you've got $1 million, you put it in the bank, you earn 40 grand a year. Doesn't feel very rich. And so people have said, well, my term deposit's matured. I don't want to go back into this again. This is just ridiculous. I'm going to go into Telstra and I can get 9%. All right, back then you could have got even higher than that, 12% or 13%. So that's why it's gone up. Okay, it's gone up because it's popular. It hasn't gone up, Peter, because it's good quality. The results came out today, the half-yearly results. I've got the cash flow statement here, and I can tell you without doubt that they cannot afford that dividend from the cash flow from operations and with what they're doing. In fact, the only do you want me to go through some stats?
Just quickly. I want you to name companies that you really like.
Cash flow from operations was $3.3 billion. What they do, they're a little bit sneaky. They put their interest costs down the bottom of the cash flow statement, not up in the operational section. Right, so that was $500 million. So they end up with $2.8 billion of cash from operations. Then they've got $2 billion of capital expenditure. So they end up with about $800 million worth of cash flow. Then they sold a business and they bought a business. They sold Telstra New Zealand to Vodafone. Okay, so they got $700 million out of that. They bought another business for about $450 million. So they end up in a situation where they end up with free cash flow of about $600 million, and their dividend was $1.7 billion. Right, so they can't afford the dividend. I reckon they are bleeding. I think Telstra can't afford to do any of the things that they love to do because they've made a commitment to the market to pay this dividend, and I don't think it's sustainable in the present form.
Do you think the NBN offers them business opportunities that could provide growth 2-3 years down the track to change that difficult
well, as you know, they're getting a big payment, right, for retiring their copper network. And,
bill, isn't it?
Yeah, well, that's the present value of it. It's actually much more than that. So from that cash, they'll pay the dividend. But as the business, as an operating business from free cash flow, they can't pay that dividend. So you've got to keep that in mind. So to me, it's not a high-quality business. The other thing is, all the best analysts that are covering this stock, and they're better than me at it, they're saying that in 2014, the profits of this company are still not going to be any higher than they were in 2002. That's 10 years or 12 years and no growth in earnings.
Okay, let's go and look at some companies that you like. It has the intrinsic market price, market price ratio you like. Okay, but they pay dividends. Any of them exist?
Oh yeah, absolutely. Of course they do. Okay. So we think one of the businesses that we've done very well out of, and I've got to confess, I own these stocks, right?
Be honest. Don't give us stocks you don't want.
It's a legal requirement, right? So the Reject Shop, for example, we think its valuation is $18.50. It's trading at $16.20. I have to confess, we bought it at 11 in the 11s.
Oh, you talked about it. It's always been.
And I've talked about the Reject Shop before. So that's a business that's doing extraordinarily well.
What kind of dividend does it pay?
Look, I think it's about 5 or 6%.
Okay.
I'm guessing there.
Yeah.
We don't buy things based on their yield. We buy things based on their quality and their value.
Yeah.
So the reason why this business, I think, is coming good now is because back in 2011, was it, the floods in Queensland? Okay, the distribution centre in Queensland was wiped out.
Yeah.
So they had to distribute to almost 200 stores from a Melbourne distribution centre. It was expensive, it took a lot of time. Product wasn't getting to the stores on time, and so their profits suffered and their margins suffered. But now that's recovering because they've got the distribution centre up and running in Queensland. At the very same time, Jan Cameron, who set up Kathmandu and subsequently sold it, she set up the chicken feed, the $2 shops. That didn't go very well. Some of those stores have been shut down, and the Reject Shop has taken the leases over on some of those stores. So they'll open twice as many stores as they thought they were going to, and that's going to be a boost not only to margins but a boost to profits as well. So we think the market will be surprised by their profits, and we think they're still cheap.
Okay, another one?
Another one. There's not a lot though, Peter. I've got to tell you, the market's run up. Before I came on, you probably knew the market's run up. So the other one that I think is still looking like reasonable value, but it's getting close now. It's not a big bargain. CSL, blood plasma products. Seek. We think the opportunity for Seek is enormous because we actually believe that their Chinese business, the ownership that they've got in the Chinese business, that could float on the NASDAQ in the next boom, and for billions of dollars more than it is valued on their balance sheet. And
a lot of people say don't buy Seek because its PE is so high. And they said it a year ago, but the share price kept on rising.
Well, look at REA Group. You know, REA is now at $20. It's trading at 10 times equity, 24 times next year's profits. And you could argue that their growth in Europe in 5 or 10 years' time may collectively, it's a stretch, but if they got everything right, it could be a bigger business than the Australian business. So the PE of 24 today would look cheap. We don't use PEs to value companies. We use their return on equity and their equity. And what we want is big return on equity and big equity. It's that simple.
Okay. So there's two companies in the dividend space. What about a company that, could be a cyclical company? Is there a cyclical company out there that you think is, ripe for a good
recovery?
A recovery. Yeah.
Look, I think the worst is behind Leightons now. I don't particularly like the business, and I'm not a huge fan of the management of that company.
The ownership and the Spanish ownership.
Yeah, there's all of that.
Confuses me.
So for various reasons, I won't ever buy that business. But you can imagine that the worst is behind it now. The write-downs have been done. So provided there are no surprises,
it's progressively getting a little bit better,
and the Americas as well. And so so slowly they're starting to improve their results in the market. But what's happened in the marketplace, Peter, is the market's recovered very quickly. I was away for January and I couldn't believe the extraordinary gains that were being made while I was on holidays. The guys at the office said I should go away more often because things seem to go very well. So that's one of them. And then the retailers. I would never buy Myer and I would never buy DJs. I think department stores are difficult. But if there's a cyclical recovery in retail and confidence improves, then you could see the share prices of those businesses go up a lot more. I think it's just the way the world works in Australia because we haven't got many stocks.
Okay, what is the Roger Montgomery destroyer? The one that you think, comparing intrinsic value to market price?
Yeah, well, out of everything in the portfolio, the things that, let me tell you what we think is cheap at the moment. There's only 3 stocks out of 19 that still look like good value. Micklin Express Offshore, Resmed, and the other one is the Reject Shop, which I've already mentioned.
Okay, so go through them again.
Okay, so Micklin Express Offshore, which is an offshore...
Tell us about that company.
Okay, so it's a business that services the oil rig business, and it's a tiny business, micro cap. So please don't go out there and rush and buy it because you'll be helping us. Go and do your research first. Speak to somebody who has the opposite view to us. The other one is Resmed, the sleep apnea business, and the Reject Shop, which we've just talked about.
On Resmed, what intrinsic value do you have on that?
Okay, so Resmed at the moment, they've just come out with an announcement that everybody perceived as a downgrade, but we think long term they'll be fine. We think they're worth about $4.80. They're trading at about $4.25, $4.28.
Okay. The big picture, I know you don't necessarily worry about the big picture, but it does affect the profitability of companies. Do you think the big picture's improving well for the kind of stocks you're holding?
I think it's benign at the moment. I think I think for Australia, the risk is that things improve more than we expect and everyone's still dour. The analysts who sit in their offices, in those very fancy offices in the city, we don't, I'll have you know, but those guys, they're the last ones to pick the turnaround. And the reason is they've just spent the last 12 months downgrading the company profits. They're out in the press saying that this is going to be a tough reporting season and so on. They'll look bipolar if they turn around and start upgrading. So they'll be the last ones to upgrade. In fact, there was some research by McKinsey some years ago where they looked at analysts' forecasts and they said analysts are overly optimistic about the profits of companies, and they regularly start high and then start downgrading through the course of the year. The only time that they get it wrong and they're pessimistic is when the economy turns around. And so that's where we are right now. The economy's potentially turning around, and if that's the case, then they're overly pessimistic.
So you think there could be some earnings surprises on the upside?
The banks, for example, everyone's bought the shares of the banks on the yield play. Okay, but what could happen, and anyone thinks that's over now, so a lot of people are saying, well, they've had their run now, it's going to peter out. But if the economy turns around and if we get some confidence, then what we're going to find is very, very quickly growth in credit. And that's going to mean that their profits could grow by more than 4 or 5%.
And they could also look around for a takeover opportunity as well.
Exactly.
Mate, always great talking to you.
Thanks very much.
And Roger also is now a star writer on the Switzer Super Report.